Hi, everybody. Welcome to the Sphere Home Loans Government Grants and Incentives for First Home Buyers. I'm Rachel. I'm from Sphere Home Loans. I've got Joe Carroll here today, also from Sphere. He's one of our star brokers.
Good evening, everyone. How are you doing?
John Pigeon had to send his apologies tonight. He has come down with a nasty flu, so we hope you feel better, John. We might kick right off. I'd like to start by acknowledging the traditional owners of the land in which we meet today. I would also like to pay my respects to the elders, both past and present. We have a jam-packed agenda tonight, government grants and incentives. I think this is one of the most confusing topics for first home buyers at the moment.
Oh yeah, big time.
Joe, you are on the ground every day talking to clients about these exact things. Tell me what you think people are finding most confusing.
Well, I think it's the breadth of all the different schemes that are available, but also the government, in their wisdom, have decided to bring in quite a few different changes over the years, which has made it quite a dynamic landscape and very hard to keep up to date with.
Yeah.
So hopefully we can provide a bit of clarity today.
We're actually just saying before we turned our camera on that we do this every single day, and we have to really stay on top of it. Like for us, even as mortgage brokers, it's really tough to make sure that we know all the grants. We work on national business, so there's a lot of different states. So we have to be quite up to date with our knowledge. So I cannot imagine what it's like to be a first home buyer trying to stay on top of all of this, and especially learning it for the first time. So we really hope that tonight we can give you some information to, I guess, for you to be a little bit more informed when you're out there talking about looking at government grants and what you're eligible for. So I think some of the big things is that I think some of the things that causes the most confusion is that there's state grants, and there's a few of those, and then we've got these national grants that come in, and there's a few different things like the Super Saver, but generally it's the state and what you're eligible for, and then the national grants, and that there's two different bodies that are looking after them, and there's different eligibility or criteria for both. So we're going to spend today going through all of the grants and incentives. So we're going to start with state, and then the stamp duty. We're going to go to national grants, and then we've got some really great scenarios that we've been doing over the past 12 months with layering those grants. So just to show you some real life examples of how people have used multiple grants and how they can be used all together. We're going to leave the chat open. So we've got some questions that have come in, but we're going to leave it open throughout the session. I think we've only got about 100 people on tonight. So feel free to ask questions as we go along, and we're happy to come back and answer any of those as we're going along.
And there's no silly questions.
There is no silly questions, but this is definitely the time and place to ask all of those. So we're just going to start off with the first home buyer grants and assistance scheme. So the first home buyer grant, for those of you who don't know, is a cash grant that's paid, and this is at a state level, but this is only if you're building a new home or buying a home that hasn't been lived in before. I would say everyone knows about these. They're really common. They've been around for a really long time, but I would say they've become, in New South Wales, like to get a house under 750 has been really tough. When was the last time you did a first home buyer grant in New South Wales?
Maybe 2 years ago now. It's just not common enough. It's too low a price for most people to utilize it, really. Something perhaps the government should have a look at, to be honest.
I know the team is still doing a lot of first home buyer grants in Queensland. I think that just seems to be a really common place for first home buyers to be utilising the grant, as well as some of the stamp duty concessions. But the home buyer grant is, as you can see, New South Wales, it's $10,000. Queenslanders are a bit of the winner here. It's 15. Tassie's even bigger there. Now, for the ACT, since 2019, there hasn't been a first home buyers grant. So there is stamp duty concessions, which we'll go into next, but there's not actually a first home buyer grant. And now when they say brand new or substantially renovated, so you can either buy land and build, or you can buy a house that hasn't been lived in before, or they've got this test that says it's got to be substantially renovated. So generally that's a home that somebody has hugely renovated and then sold. I have not done a single property first home buyer grant for a substantially renovated home.
No,
have you?
Never.
No.
Not one.
I don't think anyone on the team has. No. So generally it's someone going and buying a block of land and building, or buying a brand new home. Now, as you can see, there's price caps on all of these, and you also have to be a first home buyer. Now, there's some little quirks in different states. And I would always say my advice here would always be to check with the Revenue Office for your state if you're eligible, if you're not quite sure. So if you're both first home buyers, you know you're going to be eligible. But there's some different quirks, like in Queensland, you know, if one of your, just say you're buying as a couple and one of you have owned a property before, but it's been an investment property and you haven't lived in it, you potentially could still get the first home buyer grant. So it's just best to always check if you're not quite sure.
It's a 15 grand phone call potentially.
Yeah.
So just ask the question and see what they say. You don't ask, you don't get.
Yeah. But again, I think most people are across the first home buyer grants, but that's what they are. Moving on, it's the stamp duty concessions. So this is commonly referred to as the first home buyer assistance scheme. So when people say the first home buyer assistance rather than first home buyer grant, they're talking about the stamp duty concession. So as you can see, it's different throughout every state. So Queensland, it's up to 500,000. That you would pay no stamp duty. New South Wales at 650, and then it's a sliding scale between 650 and 800. So I think for 700, it might be $10,000, where if you weren't a first home buyer, it's about 30. So you still get a big saving, but if you're buying up to 650, it's zero. ACT is a little bit different.
As always.
They have a salary cap. So it's not about the price of the property. It's about how much you, and if you're partnered, how much you and your partner earn together. So that actually changed this year. It went up from 160 to 170 as a couple. But if you have children, that goes up slightly. So obviously, like, South Australia is nil. They've only got the first home buyers. So there's no stamp duty concession there for South Australia. And Victoria, the stamp duty concession, I find people struggle unless they're in regional Victoria to get that grant.
Big time. Yeah.
Yeah. So the first home buyer grant and the stamp duty concession, they can be used together, and they're both state-based. Now, there can be some quirks for this, but sometimes you can qualify for the first home buyer grant, so that, you know, the $10,000, but you're not necessarily eligible for the stamp duty concession. So that might be if you've owned a property before that's an investment, you might qualify for the first home buyer's grant, but not the stamp duty concession. But again, if you or your partner have owned a property before that you haven't lived in and you just want to check, it's the Revenue Office that you would check to see if you're eligible. I had a quirky one last year and I would have said no, that they weren't eligible.
Oh, that's right. Yeah.
It was a couple and they weren't living together. So they had different properties, but they were going to buy a house to live together. They were going to get married and move into this house together. So I considered that to be de facto. But at the time they were applying, they'd never lived together. And he had never had a property before. She'd had an investment property previously. And my initial thought was, you are not going to get a stamp duty concession. But I did tell them, as I always say, just check with Revenue. And they called and they bought it where he did not pay stamp duty and she did. So it was like a split. So I would say it's always worth checking. Have you had any quirky ones?
That's the question. Yeah. I think, you know, speak to your conveyancer or your solicitor as well. Always important to get that as a point of reference. But again, it just goes back to the adage of you don't ask, you don't get. You need to double check these things and make sure, because everyone's situation is different. And whilst you might think that you fall into this category, let's just double check and see. That saved them over what, $20,000?
Yeah, it was close to that.
Yeah. So it's a big saving and it's one phone call. So it's worthwhile for sure. Yeah.
Yeah. So that's pretty much the state grant. So the ones that are done by each state have different rules and different regulations. And generally it's for first home buyers, but there's a couple of little different things. And as you can see, there's some states that are bigger winners and some that kind of really miss out.
South Australia.
Yes, they have it tough. I think the ACT have it tough too.
Move to New South Wales.
You know, most clients that we have in the ACT have a bigger income than that.
Yeah,
yet they're still renting for big rents and they're struggling to get into the market deposit-wise. So a stamp duty concession, if you're paying big rent, just because you've got a decent income, it doesn't mean that it makes it any easier for you to save.
It's not backed by logic, is it really? I mean, it is unfair. Although the average income there is higher because a lot of people work for government and those kind of institutions, it still doesn't act in their favour. So
no, I would like to see a stamp duty concession come in, not income tested in ACT, but I don't feel like they're going to ask my opinion.
No, they're not.
So moving on to the national grants. So there are 3 national grants, the main ones, and they are across all the states. So this is something the government has brought out to help people get into the market. Now, these came out about 3 or 4 years ago, and when it came out, it was really tricky. They only gave about 5,000 spaces, and they released it in this January 3rd or 4th. And we actually had to come back from leave because we were closed until the 5th or something, because there was only 5,000 spots. Getting people in was a big thing, and there was like a lottery to get a ticket to get this first home buyer guarantee. Some people got in, some people missed out.
Banks didn't know what they were doing.
They didn't know what they were doing. It was a really tough time, but I feel like the government have got more of a handle on this now. The banks understand it more. It's been rolled out to about 30 banks and lenders now. So people are starting to get a hold of this first home buyer guarantee. They've also got a whole lot more spots than they did before.
Yeah.
So just to explain, the first home buyer guarantee is the government guaranteeing you into a home loan. So you only need a 5% deposit plus any of your costs, and you don't pay lender's mortgage insurance, and you actually get treated like you were buying the property at 80% from the bank's perspective, because the government's offering a guarantee. There's a couple of quirks that come along with this.
It's a really interesting one, and I'll be the first to criticize the government at any turn, but this is a brilliant scheme, because the savings that you get, they give you rates as if you had a 20% deposit. And that might not sound like a big deal, but as soon as you go into lender's mortgage insurance, the banks increase your interest rate significantly usually. But under the scheme, they don't. They give you those 80% LVR rates. And what that means for you is just week to week, your repayments are significantly lower. So this is one of the schemes I can really get behind. I've done a huge amount of them recently, and they're pretty easy as well. It started off, we did one of the first ones in New South Wales, and it was rough. It was really hard. The banks were struggling with it. We got it done, but it was an arduous process. But now they do just fly through. We're doing lots of people with it, and it's getting people into the market and getting that foot on the ladder. So I cannot speak highly enough for this particular scheme. And I think it's a really good way to get yourself in there.
Yeah, so there's some income requirements, as you can see there. So you've got to earn 125,000 or 200,000 as a couple. And here's something that we had clients held up with last year. From July 1, you need your notice of assessment. So, if you're applying right now, you need your notice of assessment for 2022. But from the 1st of July, which a lot of people are going to be applying then, you need your 2023 notice of assessment, not your group certificate. So you actually have to go and do your tax and get like that receipt back from the government. There is a plus to that though. There is.
I've got one at the moment. It's really interesting. The client's income for this year that we're using for servicing with the bank is 128,000, and he's an individual. So he's over the threshold, but his notice of assessment from last financial year is under that 125. So I can still get him onto the scheme because we're using that notice of assessment. So if you think that you might be earning over this next year, but you still want to try and get onto the scheme, strike now before you have to submit your new notice of assessment, and let's get you on the scheme and get you sorted, because it can be the difference between you needing a 5% deposit or potentially a 12% deposit.
And I think that's one of the common misconceptions. People think that they get a pay rise and now they're on, 150,000. I'm going to be on 150,000 from today, but we're looking at your notice of assessment for 22, but you borrow with the bank on your income of, once you get a pay rise, that's what income we can use from day one, day one of that pay slip. So it's got to be owner occupied. And so with the state grants, and they change from a few states, but the basic rule is you've got to live in it for 6 months in the first 12 months. Some it's 12 months consecutively, but for the majority of states, you've got to live in it for 6 of the first 12 months. But it's not like that for the first home guarantee. It's really not for a few of those clients. You've talked a few people out of this guarantee.
Yeah, look, it's all about what your long-term plans are. So look, if we're buying a home and your plan is to rent vest it, for example, which lots of people are doing at the moment, it's a great strategy in many respects. This isn't for you because it doesn't fit that criteria. What you might look at is you might buy it as an owner occupied, and then many years down the line, that might change into an investment. And that might be okay because we might have released the guarantor of the government by that point. But initially, if you're getting in and you're going to not reside in the property and you're hoping to rent it out, this might not be for you. So every situation is different, and that's a discussion you would have and go through it together.
Yeah, and people ask the question, how long do I have to live in it? But it's an unascertainable amount of time because you must live in that property while that guarantee is in place. And that guarantee can't be released until from the government's perspective, until it's 80%. So you've got to be able to refinance at 80% of the value. Now, if you're a certain industry professional and you don't pay mortgage insurance at 90%, or maybe you could refinance at 90%, you might be able to refinance and get the government off. But the blanket rule is until that guarantee is released, you cannot rent that property out, and that could be years, just depending on how the market goes.
Yeah, I mean, we had one, they were really fortunate, it was 18 months, but they saw a boom in the market. So, and that's important to note as well, it's not a case of you paying the loan down on its own, it's the loan being paid down and the value of the property going up, hopefully, as well. So, and that's something you would ascertain through evaluation.
Yeah, so you've got to have 5% deposit, and 3% of that has to be genuinely saved with some banks. But you've got to understand, this guarantee isn't a guarantee that the government's giving you. The guarantee has a certain amount of places, and all those places are going out to different banks. So you don't have to just meet the government's requirements. You've got to meet the particular banks that have these guarantees lending criteria.
That's right.
So even though we might say, well, you in the need a 5% deposit, there might be a genuinely saved. The particular bank that has that guarantee might have a different criteria. Some of the banks that hold these spots have different things where they don't take casual income under 12 months, but some banks do. And there's a particular bank that we've been using a lot of lately that will let clients use rent as genuine savings, and also have these schemes, like have these spots from the government.
And that's huge, because how hard is it to save whilst you're paying rent? It's so difficult. And if you can use that as evidence that, you have the ability to save, but obviously you've not been doing so because you're paying that rent week in, week out, it's something that can be the difference between you, again, getting in the market or not at all. Again, though, this is very select lenders. It's not everybody, and not everybody is doing the scheme. So it's a really, bespoke process in regards to that. Yeah.
And this is what we do. So, we talk to clients every day about what they're eligible for and putting them on track. But this, okay, a lot of the time we're looking at 30 different banks plus. So just for this scheme. So we might have 40 or 50 banks we work with, but maybe 25 to 30 of them actually have the scheme, and maybe 10 of them do it well. So just because you've been told you can't do something with a bank that has the scheme doesn't mean you can't do it. You just need to have a chat to a broker and see what other banks have these schemes, and they might have different credit assessment. But in summary, this first home guarantee is the 5% deposit is all you need to get into the market, which is huge, but 5% plus costs. So if you have to pay stamp duty, then you still have to come up against that. So if you're in New South Wales and you're buying for $650, you only need 5% deposit because you don't have stamp duty to pay. But if you're buying for $1 million, you wouldn't anyway, because with the cap. But if you're buying for 800,000,
that's a 34 grand you've
still got to have that stamp duty, unless you use another scheme where you don't have to pay stamp duty. So that's the 5% deposit. Now, there's some other guarantees that look very similar. The other guarantees the government has that look very similar to this. These are the two other ones. So there's the regional scheme, which is just pretty much the same as the other
very
scheme.
Very similar,
but it's for people in regional areas only. So if you lived in Dubbo in regional New South Wales and you had lived there for 12 months and you wanted to buy a property there, you would have access to certain places in the scheme that people in Sydney didn't. But if you were living in Sydney and wanting to buy in Dubbo and move there, you actually wouldn't get one of these schemes. You have to live in the regional area for 12 months before you can apply for the regional spot.
Sounds harsh. It's actually really good policy though, because it protects those regional hubs from, them being bought out by people moving from these big metropolis cities. And I think, again, I'm normally the first person to criticize the government's policies, but it's actually a really logical policy they've put in place here to protect people and make sure that you can get into that market. On this note, in regards to, I always struggle with this concept of, what's regarded as regional and what doesn't. There will be a link which we'll be sending out where you can put in a postcode in your area and find out under which remit you fall under, which is really helpful, because I really struggle with that. I don't understand how they said it.
Huge disclaimer on this. I always recommend that you go onto the particular government site. So we'll send out a link to both the state, for each state, and their national website. Go on and check it out. That's what we do too. So when we're talking to a client and we're not quite sure, we call up the number on the the national line, and they're really good. They answer us really quickly. So the best thing to do, if you're not sure about where, if that's regional, if it's not, what the income cap is, or what just give that particular number a call. So we'll send that out and just ask about exactly what you're buying. There's an online postcode calculator too.
Yes, yeah.
So this is one of my favorite guarantees, which is new, that's come out. And I think this is the one that I feel like no one knows about and that people need to know about, which is the family home guarantee. So this is really, really cool, and it's aimed to help people get back in the market. So it's not just for first home buyers, but it's for single parents that might struggle to save a deposit. You've probably done a few more of these than I have.
Yeah, they're getting more popular. Again, we have a major issue with this one, is nobody knows about it.
No one knows about it.
So it's educating people and explaining what it is and how it would be applicable to you. It is a fantastic way to not only get into the market, but also to get back into the market, once you've gone through a separation and things like that. It's a great product, but it's just not spoken about as much as perhaps some of the others are. Yeah. So we're just going to take you through that now.
Yeah. So basically you need a 2% deposit. So you need a 2% deposit, and the government guarantees the other 18. So from the bank's perspective, they're only lending you 80% of the value of the property, but they're actually lending 98% because the government is guaranteeing that other 15%. You still need to have, there's certain criteria you still need to have. So you might look at a bank and the bank might still want to see 5% genuine savings, which makes that tough. But you do only need to put in 2% plus any costs. So you've got to be a single parent. And by single, it actually has to be divorced. One of the brokers in our office got caught with this, where they were talking to a client and she was separated and had been separated for 7 years. But to get this grant, they actually want you to have been divorced. So 125,000 income that you can own. It's got to be for owner occupied. This really is designed for the family home, secret to the name, family home guarantee. It's not for, renting out down the track. And this is the only national scheme where you can have owned a property prior.
That's massive.
It is massive.
That's really significant, because people, you set yourself up and then things happen, separate, and then you want to get into a property and have that stability again. And this is the government trying to make that happen. Again, a very logical scheme to get people back into the market at a comfortable level.
Yeah, and I think we see a lot, and before this scheme came out, especially, you see a lot of people that have had a property with a partner down the, way long ago, and they didn't come out with anything, or they didn't come out with enough to get back in the market. And it's really hard, especially as a single parent, to save a deposit. So I think this is a really great guarantee, and I want more people to know about it.
Yeah,
so if you know a single mum or a single dad, tell them that there is something that's come out from the government that, is really different for them. So I know a lot of the brokers in the office have people on savings plans, getting them ready to use this. So, 2% it doesn't sound like a lot, but it's still a lot for someone who's renting and, working and paying daycare fees or school fees. Yeah. So I think the more people that know about this one, the better.
We've got a question here from Mr. Anonymous. Do you also need to have your latest income tax assessment when you apply for the regional and family home guarantee schemes?
Yes, you do.
Yeah.
So the notice of assessment is really important. So you can't just have your group certificate. You need to have your notice of assessment. So most people, this time of year, it's not an issue, because most people have done their tax from last year and have their notice of assessment. Where people get caught is in July. So there were some changes that came out, which we're going to go over right at the end. We're going to go over the changes. So there's different people that this is opening up to in July, and you can't get a spot until July, but you also have to have your notice of assessment.
Yeah.
So there's going to be this thing that happens in July, where there's going to be this mad rush of racing to get these new spots, but you need your notice of assessment. So the quicker you can get your tax done, the better. But I'm really glad you asked that question, because there is a big difference between notice of assessment and group certificate. But as Joe said before, you can use that notice of assessment rule to your advantage.
Well, double check. If you're thinking about going on this scheme and you think you might push yourself just over the threshold into the new financial year of July 1st, have a look and make sure, you know, that it is feasible now. Maybe it's time to strike now rather than waiting, because if you go over that 125 or that 200 as a couple, you're going to push yourself out of this scheme.
And if you have a big bonus due, could it be paid on the 1st of July?
Absolutely.
Does it have to be paid in June?
I'm not saying anything to that.
But it will go on whatever. If you're going to apply in July, it will be on whatever your notice of assessment is for the 2023 year. But if you were applying right now, it would be 2022 notice of assessment. So there's a table here that has the max purchase prices. So as well as the income requirements. So it's 200,000 for a couple, 125 for a single. There's also max property purchase. So in New South Wales, if you're in a capital city or a regional centre, it's 900, but the rest of the state is 750. Victoria, a little bit lower. Queensland, a little bit lower again, and then they've got all the others there. So if you're, I still think you're right. The biggest confusion is what is regional centre as opposed to rest of the state. And the national scheme website has a calculator for you. So you can just put your postcode in and it will tell you what that income cap is. They have a little calculator online. Or anyone who's on this webinar, I'm going to give you an email at the end, which is hello@spherehomeloans.com.au. Everyone can just book in a 10-minute check with one of our team. You might be lucky enough to get Joe, and you'll have 10 minutes of talking to a broker and just say, look, this is where I live, this is what I earn. Tell me what I'm going to be eligible for, and we can help you through that as well. And
don't be shy as well. A lot of the calls that we've had previously have been like, they're not ready now, but then they want to be ready in the next 6 months or 12 months or, even 18 or whatever it might be. So don't be shy if you don't think you're quite ready yet, but you want to reach out and get an idea of what your plan is going to be moving forward. That's what we're here for. We're here to answer questions, simple things like giving you your borrowing capacity, which often sort of dictates the conversation as to, well, I want to buy at this point. So where does my income need to be and what deposit do I need to have and what scheme would I be eligible for accordingly?
Yeah, there's just another question that's popped up on the income for these the national schemes. And I thought there'd be a lot of questions about these because these national schemes are the ones people are most confused about. Yeah. So would it be based on gross income or net income, including deductions? So it is basically on the notice of assessment. So if I earned $100,000 this year, but I had $10,000 in deductions and my taxable income was $90,000, that is what my taxable income comes back at my notice of assessment. So it's whatever's on your notice of assessment, not the group certificate. So your group certificate would have a gross payment on it, but your notice of assessment, your taxable income that the government assesses, has your gross income minus deductions. So really that's a bonus as well, being when they use the notice of assessment, as annoying as it is that you have to have done your tax to get it, that might
make it work for you.
That might be the thing that scrapes you under the line. They're really firm on that too.
Oh, yes.
There is no, we've called up with a few that have been
no wiggle
1,000 off. No. There is no wiggle room on that income. So I hope that explains a little bit more about the national guarantees. And again, these national guarantees can be used in conjunction with any of the state ones as well. If you were using just on those national guarantees, so it's really like, in essence, it's really like a parental guarantee, but you're using the government instead of your parents. So if you used a parental guarantee, you would have pretty much the same thing. So if you didn't qualify for one of these, you've still got the option to use a parental guarantee, and then you can still layer that parental guarantee. You wouldn't get the national scheme because you're using your parents as a guarantee, but you can still get the first home buyers grant, the stamp duty concession.
The concept's the same.
And do a family guarantee. So this government guarantee or the national scheme is really just like a parental guarantee, but the government's guaranteeing you instead of your parents.
And it's not for life. They're not on there. They're not guaranteeing it for life. It's to the point where you can release them at that 80% as we spoke about. The rates are great. It's a good opportunity to get your foot in the door, your foot on the ladder. It really is.
Actually, I wanted to tell you something. One of the brokers in the office had an appointment that she wanted me to share on this session at this time, and it's just come up to me. So she had a client that they were buying for $1 million, and they thought they were going to get this the first home buyer guarantee. They had their 5% saved and they thought they would do it in $1 million. They could not get in their area for the 900. It was in Sydney, and their parents actually did the parental guarantee for them, but it was just, they didn't know about parental guarantees at all. And they came to us for this national scheme, and then their parents were in on the appointment, and then when they found out they weren't going to qualify because they just went over, their parents said, well, you said it was like a parental guarantee. Explain to me. They didn't know what a parental guarantee was. So it's really similar to a parental guarantee, but the government is guaranteeing you in. But yeah, sometimes the property cap out means that you may not be eligible.
And that's when we'd explore those other options. 100%.
And there is other options. Now this one is the new one that came in this year. This is that caused a lot of controversy when it came out. It is New South Wales specific, so apologies to all the other states that are on. This is just New South Wales, but the big stamp duty choice, which is you can choose whether to pay stamp duty as a first home buyer or an annual land tax. And I was offered at the start, and now I love it.
We're all on board now.
We're
I love
all on
it.
board.
I think it's awesome. I think it's great. What
do you like about it?
I just think there'll be very few scenarios where it makes sense for you to pay the full stamp duty up front. Now, as we know, stamp duty roughly equates to about 4.5% of the purchase price as a general rule. That's a lot of money to save. It's already hard enough that you've got to save, the 5, the 10, the 15, 20% deposit, whatever it is that you're aiming for, especially if you're renting. But then to save that additional stamp duty on top, it's a lot of pressure and it's a lot of work. This new scheme that's come in for New South Wales only, again, apologies, is excellent because it gives you the ability to purchase at that higher price without such a large deposit to cover that stamp duty.
So just to clarify, if you're a first home buyer in New South Wales, you do not pay stamp duty up to $650,000. So this is not for people buying under 650. This is for people who are buying over 650 and up to 1.5 million that can now choose whether you pay stamp duty up front or whether you pay an annual land tax. Now, I have clients that have no choice. They have to choose the annual land tax. But then I've also got clients who have the cash there to get in and pay stamp duty, but they know they're going to save money by not putting that cash down. So I put this example in, which is a lot of people get 90% no mortgage insurance loans. Like a lot of people in different professions, you can buy and have a 10% deposit. And this is a really common thing where people who do qualify for the 90% no mortgage insurance want what they can get with the 10% deposit. So just
accountants, professionals, medical professionals, there's a whole range of careers.
So $1 million property, they would need $100,000 deposit, and up until this year they also needed to have $45,000 in costs, and 40,000 of that was just stamp duty, which is huge to have. Now you can get in still with a 5% deposit, but a lot of people at this level, because mortgage insurance is so big, are trying to get in with that 10% no mortgage insurance. So under the new scheme, with this same scenario, the client would pay an annual land tax rather than the $40,000. Now, we did this scenario where the land value was $548,000, because you don't pay on the property value, you pay the land tax on the land value and what the government
says, which is always lower.
It is always lower, and they come out all year and they tell you what the land's worth. So this client would actually have paid $2,044 per annum, and we did a little bit of a research because like I said, I was off this at the start. So I thought, an annual land tax, the government's going to charge people all this money over all this time. They're going to jack it up.
We were suspicious.
But they've actually capped it. So they can't put it up more than 4% a year, the land tax. So even if your land doubled in value next year, they can't double your land tax. It's capped at a 4% increase every year, which I thought was good. But then the average client of ours, and we did this data before this webinar, it's 6.5 years that a client actually holds their first property for, which we've got clients that hold them a long time, and a lot that maybe, get in at 3 years and then upsize. So even if you had that 40,000 and you held this property for let's say 5 years, you'd be paying 10,000 in land tax, but you've saved 30 grand.
It's massive. It's for the people that have the choice of either paying the stamp duty. To me, it's a no-brainer. I'd be paying the land tax straight off the cuff, because it's unlikely you're going to stay in the property long enough to justify having paid it up front anyway. And moreover, if you've got that money spare, you might have it earmarked for something else, for some other kind of investment strategy. So to me, I would have that to one side if I can, and pay that land tax and just, reap the savings in the long run, really.
Now, we've had questions about this.
We've got a cracking one here, actually, from Jen. Jen has said, what are your thoughts on stamp duty choice, New South Wales, if intending to turn the property into an investment after staying in the property for the qualifying time, noting that the property tax is much higher for investment properties?
You are completely right. So I have done a number of these scenarios, and you can go on and work out what your land tax would be, but land tax for investment properties is more than land tax for owner occupied properties. So if it does change to an investment property, let's say you're going to live in it for 12 months and then you're going to keep it for 30 years as an investment property, I would say you'd probably be better off not paying the land tax, but it might be, for a lot of people, it's a difference of being able to get in or not.
Yeah. I mean, look, that all comes down, it's a great question, Jen. It all comes down to strategy. And all you're going to be doing there is a cost benefit analysis. If you know what your long-term plan is and you do intend to keep the property for over a certain period of time, you'd work out what you pay as stamp duty up front, and then you divide that into the amount it's going to cost over the period of which you're going to hold it, and then work out which one's going to be more fortuitous for you. So that would be you working out, okay, well, what's my long-term plan in a worst case scenario in terms of holding the property and paying that tax, and going, well, I'm either going to pay it up front because that's going to work out cheaper in the long run, or actually, no, I might well release it after 5 or 6 years and I'm still not going to be at that $40,000 as this example is here.
And that land tax has to go into the servicing calculator for servicing. So let's say you're paying a couple of $1,000s a year in land tax. We also need to put that into the bank's calculator when you're borrowing. So if your long-term strategy,
another great question.
Yeah, if your long-term strategy was to hold that property as a long-term investment properties, and a lot of our investors do hold them right until retirement, I would be much more inclined to pay the stamp duty up front.
Absolutely. It's all depending on what your investment portfolio strategy is, and then we make an educated and informed decision based upon that.
Now, I've just had something to Shannon just said a very good point, and this is exactly what I thought. The land value in Shannon's area went up 200,000 this year, and this is what I was off at the start until I did a little webinar myself. I went on and learnt about it from State Revenue and found out that they have capped the land tax, that it can only go up 4% each year. So, and I think they're only protected while it's an owner occupied. I don't think they've put that protection onto investment, but double check, there's a calculator online that you can go in and just add it up. But with that, if your property did go up in $200,000 the next year, your land tax wouldn't go up more than 4%. And that's why I was so off at the start. Until I learned that 4% rule, I was completely off this, because I've seen blocks of land triple in value over 10 years.
10 years, yeah. And the growth has been exponential, especially in the post-COVID years. So it would have been quite frightening. You're absolutely right to ask that question, Shannon. But I think this 4% cap really does kind of protect you in that. It
does. But to the best of my knowledge, it's only while it's an owner occupied. So I still like I guess the nature of this grant is for owner occupied homes. It is to get into your first home and get you on the property ladder. It is not designed for a long-term investment strategy.
No,
this is not for this wasn't designed for invest. I'm not saying you can't use it as one, but I'm just saying it's not going to be it's going to be much more beneficial while you live in the property. But if you look at the average client of mine buying their first home, it would be buy your first home, you hold that between 3 and 7 years, and then you upsize that house. And a lot of people think they're going to keep that first house as an investment, but then they've paid so much off their owner occupied home that it actually works out better for them to sell that, buy their next owner occupied home, and then use the equity in that house to invest. So, this rent investors are a little bit different, but people who go in to buy their first home, pay it down, and then go, well, I want to upsize and I want to invest, tend not to hold that first property as the investment property.
Very, very rarely. I think if you're looking at an investment strategy and you're buying your first home, you leverage that and use the equity that you build in that to move on to your next stepping stone property, not necessarily turn it into an investment. Yeah.
No, I'm not trusting the government of the day, Shannon.
Never.
I have been very dubious. Shannon's just said, I guess you're also trusting the government, but they have put it in writing that there's going to be a 4% cap. But again, I was as dubious as you when it came out, but I do think for the people not holding those properties for 30 years,
it's a great choice.
It's a great choice, especially for those people who can't get in without it, which most of the people we're talking to, it's not a choice. It's not stamp duty choice. It's, I cannot get into the market if I'm paying this sort of stamp duty. I'm renting in Sydney. I've got this much money.
And it's up to 1.5. Like that's like 60 grand. So it's a massive, massive saving that you don't have to make. And 60 grand, that's a long time's worth of, that annual land tax to get up to that 60. So yeah, I think it's great.
And a couple of things to note, the land tax doesn't stay with the property. So let's say you buy that. And a lot of people have thought it devalued their property. I've had so many emails about this. It doesn't devalue your property. You buy the house using the land tax option, and let's say you sell that house in 5 years' time and upsize. There's nothing attached to that property that says it's got land tax. It's finished. It was attached to your owning of that home. And then when you go and buy something else, you pay full freight in stamp duty. You've only got one bite of the cherry. But if you had paid stamp duty up front, you still would just pay it again anyway. So, if you're doing a house and then upsizing, you're going to still save a lot of money. If you save it, even if it's under 10 years, you're saving a lot of money.
I wish this was in place when I bought. That's for sure.
You paid a lot of stamp duty, and that is the average.
I don't want to talk about it.
Now.
It hurt.
It hurt. It hurt. Jen wrote, also worth noting that the stamp duty choice is being scrapped by Labor in July. I haven't seen that. Is that confirmed?
It's not confirmed. I know that it's in the works, and there's a lot of contention about it because there's been quite a few arguments that it might have been a ploy for votes and whatnot. So I don't know whether it's been fully confirmed. And the other point of that is it has to pass through the two houses. Also, when it comes to anything like this, there is a lead time from when it can be removed. So that time that can stretch all the way up to January for next year, or possibly even the new financial year.
Yes, but I would wait until it gets passed. And if it does pass, I'm assuming there'll be something else that would come out.
Yeah, it's an interesting point.
Or they might up the stamp duty.
Yeah, and it has been suggested that they may even look to introduce this in general as a choice for everyone eventually, because the government don't like these huge influxes of stamp duties, big lumps of cash coming in, but would rather continuous guaranteed amounts, which enables them to budget better, we would hope. So let's wait and see what happens with that. I'll be very intrigued to see. Absolutely.
Yeah, but for now, you've got that stamp duty choice. If you're buying over $650 in New South Wales, you've got the choice, and happy to do those numbers with you to work it out if, whatever scenario you're working.
What happens if the title of the property becomes an investment property?
You can log it. So once you've met the requirements of time, it can be an investment property, but then it changes that the land tax is there. It's based on an investment property. And that, as Jen said, it's higher. So you can, when you go onto the calculator, you can go to the calculator online and work out what it would be as an owner occupied and what it would be as an investment, and see the difference.
You'd also have to inform the government that it's become an investment property as well.
Yeah. And a lot of our investor clients pay land tax every year because they're holding a number of land tax. They're holding a number of investment properties, and they've paid stamp duty on those, but because they've got more than a certain amount of property in the state that's investment, they pay land tax on their portfolio. So land tax is a common thing for a lot of people. They're just introducing it instead of this stamp duty.
Yeah, that's right.
So scenarios, layering the grants. So this is the stuff where you can actually see how people can use these grants and incentives together, to buy their first property. So this is actually a scenario of, this was actually a really exciting one. It was a client of one of our brokers, Genevieve, and she had been working with this client for maybe 6 months, saving for a deposit. She actually lived in out of Western Sydney and was wanting to buy, and she just could not find a property under 800, but she had about between $40,000 and $50,000 saved. And this was last year and before stamp duty choice came in, and there was just no way for her to get in. She knew she was going to be able to get, she wasn't able to get the first home buyer assistance scheme because the stamp duty one, because that cuts out, at 700,000, it's really cut out for her. So if she was buying under 650, she wouldn't have had to pay stamp duty, but she could not get into the market under 800.
She was renting as well, wasn't she?
She was renting, but she also cut it up. So she opted for the land tax option, which came in. So we actually called her when it came in and said, and let her know that she was able to get into the market. That was in January of this year. So she could use this first home guarantee, which means she didn't pay that $30,000 in lender's mortgage insurance. Because when you're buying up at that 850 level and you've got a 5% deposit, you still have to pay, before this first home buyer guarantee came in, you still had to pay 5% mortgage, you still had to pay the mortgage insurance, which was about 3%. So you needed to have, at the point where we were talking to her last year, stamp duty, the deposit, and then mortgage insurance. So stamp duty was, like I said, it's about
34, maybe
34. Mortgage insurance was 29, and then she had to have the 5% deposit, and she only had the 5% deposit. So once she realized she'd get the first home guarantee and then the land tax option came in, she was able to get into the market with $47,500. So that's all that she contributed to an 850 purchase. But as you can see, now she's paying an annual land tax of $2,050. And that's something we have to take into account for borrowing. So she's got to pay another $2,000 a year in land tax, which very well could go up if her only 4% a year, but it can go up. And then the first home guarantee means she's got to live in it for the whole time that guarantee is in place. But for her, that was a massive win, and it was someone who wouldn't have been able to get into the market without these guarantees.
Well, she just couldn't save anymore. It was just so hard with paying rent, but then also trying to save. I'm sure it's a common problem amongst a lot of people, especially if you're living in, areas such as Sydney or, Victoria, wherever it might be. It's so hard to put that money aside. We all know cost of living is going up and everything else. So having this opportunity to avoid that additional cost up front, her income's great, but being able to avoid that upfront cost was massive, and it made the difference. Yeah.
And I think the biggest, people talk about not, when you're buying a house, not borrowing too much. And I really agree with that. You don't want to overcommit yourself. But for this particular client, she was paying as much in rent as her mortgage repayments were. And that is so common in Sydney. And I think what we see people battle with all the time is the ability to get in, not through their income, but through their deposit. So, you can see how these two schemes together have been laid to really change. They changed the funds that she needed to get into a house by $60,000.
That's massive.
It is massive. So it less than halved her need to get in. Now, you've still got to be able to pay the mortgage. You've still got to be able to pay your mortgage, and you don't want to overcommit. But if you can get in the market, that's generally the biggest thing. I think so.
Look, there's two very different things of what the bank is saying you can afford and what you feel comfortable with. And that's always a discussion that we have with every client, because we never want to put you in a position to be a slave to your mortgage. We want you to have the lifestyle that you want, whilst also having the home that you want. And that's really, really important. But, in this circumstance, it wasn't a case of that. The serviceability was there. She could service the loan. It was just that deposit position.
Yeah.
And it's just so hard to get to that point.
Yeah. So land tax for New South Wales, the choice, and the first home guarantee scheme, which was obviously the national. So this is what we call the hat trick.
The trifecta.
It doesn't happen very often, but this is where you can get the three government incentives and layer them all together. So this is a couple buying in regional Queensland. They had a very limited deposit. They had $30,000. Another factor that came into play for them was that only 15,000 of their deposit was genuinely saved. The rest of it was gifted. So that was that sort of took some lenders out of the equation for them. But they were building a property in Queensland. And like I said, they had about $30,000. So they qualified for the first home buyer assistance scheme in Queensland, which means they don't pay stamp duty. That was a big saving for them. That was about $15,000. The regional first home buyer guarantee. So just like the other first home guarantee, like the government's guaranteeing you, but they got one of the regional places, which means they didn't pay lenders mortgage insurance.
And had a lower rate.
Because if they had a mortgage insurance, their rate might have been
a percent higher.
Yeah, it could be 1% higher at 95% than at 80%. And then the first home buyers grant, so they got the $15,000 as well. This was huge. So it was $44,000 in savings across the 3 grants. And that is a lot when you think about a $500,000 purchase price.
Absolutely. I mean, on the note of the money that was gifted to them, obviously that can't be necessarily considered as genuine savings. So what we had a look at doing was using rent in lieu of that. So the rent that they've paid we use as evidence as their ability to make those savings moving forward, because obviously they're not going to be paying rent once they're in their own occupied home. But really important to note here, not every lender does this, and not every lender will accept that. So you have to be really careful to make sure you're going with the right lender that not only does the scheme, but accepts the conditions under which the policy of which you're looking for. Really significant.
Yeah. And I wouldn't be worried about, like, if you have to use a particular bank because they offer a particular quirk in their policy, I wouldn't be worried about that as the client. Our job as mortgage brokers is to negotiate the rate wherever we put you. And a lot of the time when we're negotiating that rate with the bank, they don't know we have to go there for some particular reason. We're going onto their pricing portal, and we're comparing them with all the other different banks, and we're showing them what other offers we can get. And they're coming back with a great rate. But they don't know that, hey, we actually need to use you because you've got this spot in the scheme and you take rent as genuine savings and you'll take 6 months casual income. They don't know that when we're negotiating. So if for some particular reason your broker comes back to you and say, look, you've got a choice of 2 lenders, I wouldn't get disheartened about that. It's just about your broker's still going to be able to negotiate a great rate there.
And we're not going to tell them.
We're not going to tell them. So that's, I mean, this is the client, they actually up keeping 5,000 out, but they had $25,000 in, and they bought a brand new house at 500,000. The next one is this is my favorite guarantee. Someone that actually we got into using the family home guarantee. So this was, a single mom working full time. She had a 10-year-old child. She was renting, and it was really hard for her to save, even though she earns 115 grand a year. That's a really strong income, but she'd saved $22,000. And without this guarantee, without these 2 guarantees, she just wouldn't have gotten in the market. So the 2 guarantees she used was the family home guarantee, which is that one you only need the 2% deposit. She earned under that cap of 125,000 just, which was excellent for her. Again, that goes on her notice assessment. So she maybe got a bonus this year, and we were using the notice assessment last year. That wouldn't come into play. I actually think we were using more income
than what the
notice of assessment. But her notice of assessment was 115. So that's the government guarantee there. And then she also was a New South Wales first home buyer, so she didn't pay stamp duty because it was under $650. So she's not paying a land tax. She pays no stamp duty. So if we just pop back to this one in Queensland, because they got the stamp duty concession, they have to live in that property for 6 months in the stamp duty. But with the regional first home buyer guarantee, which was the grant 2 they used, they have to stay in that house as long as the guarantee is there. So even though the stamp duty one has one requirement to stay in for 6 of the first 12, they still have to stay in that house until the guarantee is released during the regional scheme. So as with this one, you've got the first home buyer assistance scheme where she only has to live in that house for 6 months in the first 12 months, but she's got the family home guarantee, which means she's got to stay in that house as long as the guarantee is in place. Now, the family home guarantee, generally, people aren't rent vesting. They're buying this house for the family home.
Stability.
The stability. And this is exactly what it's for. This sort of thing is the reason this guarantee came into place. And whether we love the government or not, I feel like this is really helpful, and single parents are really going to benefit from this. Like I said, no one knows about it.
Never just get back in there. Like sometimes things don't go to plan, and you've got to restart again, and it gives you that opportunity to do so. And I think, again, it's backed by logic. People understand that it's really difficult to get to that point, especially if you're renting again and there's that huge expense. You know, obviously we know how expensive childcare can be as well. This gives you that opportunity to get back in with such a small deposit. And again, the rates are still really aggressive. We're not talking like really expensive interest rates, like it was a low doc loan or something like that. They're really decent rates that you're going to be able to repay. And it's giving you that chance to just get your foot back in that door.
Yeah, so that's the third scenario there. Now, finally, I just want to go over some recent changes. So you might have heard in the news, it was only about 2 weeks ago.
Yeah, 2 weeks, yeah.
They've come out and said there's some changes to these national grants. So not the state grants, but the national grants, and they're going to be in place from July. But again, if you're going to apply in July, you need your notice of assessment. So you no longer need to be a de facto couple to use this national scheme. So if Joe and I were both first home buyers and we wanted to buy a property together and we had 2.5% each and we wanted to stick that together and buy a house, and a lot of people are doing this now, it's the only way they can get into the market. They can't do it as a single, but they're also not coupled. They can buy as friends or as siblings. So this is great. So you can buy with your brother or your friend.
I've got a few of these actually.
Yeah, you would.
Quite a few siblings and definitely some friends as well, especially if you've got kind of a similar career path and at the same kind of stage, but you still want to get into the market and start to build that equity. This is a great option. And it's a really good change that they've made to the scheme, because it might enable you to buy for that little bit more. You can use those dual incomes that you otherwise might not have been able to do unless you had that de facto relationship.
Now, remember, you still got to both live in it.
Yes.
So it's going to be an owner-occupied property for the time. So it's extended to people who've owned property before. This is huge. I've actually got a client that's also a friend that I cannot wait to get in July. He had a property in his 20s with a partner, and they separated. He came out with absolutely nothing, and he's been renting in Sydney ever since and has not been able to save up a lot of a deposit and was never eligible for anything. And I cannot wait for him to get back into the market. So there's a lot of people go, 10 years, that's a long time. There's a lot of people who owned property 10 years ago that are struggling to get back in the market.
Put on their parents' property as well. We get quite a few people that put on their parents' property, and the parents put them on there to help them secure the loan originally, but it's not their property and they're not residing there anymore and they've not had it for 10 years. Well, this gives them that opportunity to get back in with that smaller deposit, because once you've had that gap and you've been renting for that period of time, the government have reclassified you essentially as a first-time home buyer, which makes you eligible for this again, which is great.
Not the stamp duty concessions.
No.
Not the first home buyer grant.
No.
Just the national schemes.
Yeah.
And the third one, this would have been nice for you too, Joe.
Yes, it would have been nice for me. Yeah. So, and this is something I'm coming across more and more for permanent residents. I mean, look, we all know how long it can take to become a citizen and how bloody expensive it can be. So this is fantastic new scheme. It means that you're available for permanent residents. They can still apply. And it's just making a big difference. We have quite a few people come through the permanent residents. And
a lot of permanent residents.
Yeah.
And a lot of people, it takes them a long time to become a citizen.
Yes, it does.
You took a long time. You were working here for 5 years before you became a citizen.
I've got it now though, so you can't get rid of me, which is nice.
But I just think that a lot of people who weren't going to be able to get these grants. There's 35,000 new spots coming out in July, and they were open to these people. So biggest thing is get your notice of assessment done. Book in for one of those chats. I did not put the email on here that I thought I was going to put on.
That's right.
I'll send it out. It's hello@spherehomeloans.com.au. If you email us and you can book straight in with just ask for an appointment with a broker. From this webinar, you get 10 minutes of just having a chat, and we can go over any of these grants that you're eligible for and talk about the state and national grants as well, because they are quite confusing. So it is nice to go over it. Now, I have had a few questions that got sent in before we started from when they registered for the webinar. So I just want to go through a few of those. Katie asks, are there any grants available for first home buyers, but that are buying for investment purposes? These first home buyer grants aren't for investors. Now, the stamp duty concession and the first home buyer grant, depending on your state, you have to live in it for 6 months in the first 12 months. So we have a lot of clients that would live in a property for a certain amount of time, and then it becomes an investment property, and they still get those grants, but not those first home guarantees.
No.
None of the ones where you only need the 5% deposit, just those state ones.
Not until those guarantees are released anyway.
Yeah.
So we've also got a question here. It says, mainly interested about how to buy a property as a single parent who's a casual employee. So I get a lot of this. In terms of casual income, there's nothing from the government scheme perspective that's preventing you from lending from a casual perspective, but it's the lender's individual policy that dictates whether or not we can use that casual income. Some lenders want 12 months. Some lenders want 6 months when it comes to casual. We just had a bank come in literally last week that said that we can use day one casual as long as you were in the same profession from the job that you've left previously, and it's within 1 month. So it all depends on your particular scenario, and that may well dictate which bank we take you to. This is a perfect example of, let's have a chat. Let's just go through what your option looks like, what your scenario is, and have a discussion. And it may well be that we need to wait another month or 2 months or so, and that's fine, but at least we've got a path to the end of the journey to get you where you want to be.
Yeah. Now, Jane's asked about the first home buyer super saver scheme. And she's asked, what are the tax implications for the year you take out, say, 50,000 on contributions towards your deposit? Now, we didn't go over this guarantee. It's kind of, I guess it's not a grant, but it is an incentive. So the first home I always get
first home super saver scheme. Say it 5 times fast.
Is the one where you sort of make extra contributions to super, and you're saving for a home in a tax effective environment. Now, I would check with your accountant about this one, and I always check. We would never quote what the tax implications are for this, but in the cases that I've had where people have taken the money out for a deposit, as long as they've had that as scheme approved as they're buying, I've never seen anyone have any tax implications of taking it out, as long as they're doing it within the rules of the scheme. So I feel like there's a helpline about the super saver scheme.
Super saver scheme. They also give you a determination, letter of determination from the ATO when you take it out, and that can be used as evidence as well. I really rate this. I think it's a great way to save. I think, if like some people really struggle with saving behavior and that kind of thing, this is a really efficient way of doing it, and it basically forces you to do it. So I think it's a really good thing to look into if you're struggling with that kind of control and whatnot.
Yeah. And one other question has been asked, which is information about Canberra and guarantor loans. So I'm assuming if you're talking about the guarantor loans, I'm guessing you're talking about the parental guarantee, or so if it's a parental guarantee loan, if you do, whether it be the government guarantee or a parental guarantee, if you're in the ACT, the only thing is you're still going to get the stamp duty concession if you earn under a certain amount.
The threshold, yeah.
If you earn under the threshold, you will have that scheme. And if you want to get the government guarantee with the 5%, you will still qualify for that. And you can use those two together if you're under the 170,000 as a couple. But again, if you were to qualify for the first home buyer guarantee under 200,000 income, it does as a couple.
Yeah,
you wouldn't necessarily you wouldn't get the stamp duty concession because that's 170,000.
Yeah.
So you'd have to earn $170,000 in the ACT to qualify for both. And I imagine there's going to be a few people in the ACT that are going to qualify for the government guarantee, the national one, but not the stamp duty, because their income will be over 170. But if you're talking about parental guarantees, regardless, you could do a parental guarantee anywhere, because that's your parents helping you. And then you would still get the stamp duty concession if your joint income was under 170,000.
Yeah, I just literally last week just had one formally approved. It's a guarantor loan. Parents resided in the ACT, and that's where the guarantor property was. They bought in Victoria. So, it doesn't matter where your property you're buying is relative to where the guarantor property is, as long as there's sufficient equity there, which is something that we would check for you. That's no problem at all. We do a lot of parental guarantees, actually.
We do a lot of parental guarantees, but I have noticed that since this first home buyer guarantee has come out, we are doing less, because people are opting to use the government as the guarantee if they qualify rather than their parents. I think most of the parental guarantee loans I've seen in the office, in the past 6 months have been people buying over that 900 mark.
Yeah, definitely.
Which is really common.
Yeah, very common.
So I feel like that just about wraps up our government guarantee webinar. There's no more questions there. If you do have any questions that you didn't get answered today, please reach out to the team. hello@spherehomeloans.com.au. We are going to send out an email with a list of the references for you to do your own fact checking, both at state and government resources. We're also going to send out our email as well. So please reach out if you've got any questions. Book in with one of the team for a 10-minute chat. It doesn't cost anything, and we would love to give you the information for you individually.
Get in touch, guys. We love talking about this stuff. This is our passion. So yeah, just send us a message.
All right. Thanks. Have a great night, everybody. And thank you for joining us.